Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Chris Dearborn, Brian Joyce, and Maddie Radner on the Nasdaq Market Intelligence Desk. We're here to discuss the bifurcation in the U.S. economy and how that is impacting the consumer and labor markets. Great to see everyone, as always, and Chris, this is a theme that we've been covering on the desk for quite some time here, is the bifurcation that we're seeing in the economy and how it's impacting different areas of it as well as different areas of the consumer.
When you look at the data that we saw last week that came out on the economics front, it's really kind of like a mixed message, right? You had a flip-flopping of data, which led to a flip-flopping of the market. And what you had there at the end of the day was positive data. The NDX finished up 2.5%. You know, in the beginning of this week, you had the S&P 500 and the NDX also making new all-time highs. So the question is, we are seeing a slowing of the economy. You saw the unemployment rate tick up to 4%, but with that, you saw wage growth as well. The week before, we had the PCE data, which showed in line at 2.8%, which was nice to see. Finally, no surprises whatsoever. And then what we're looking at there is rates. So where the 10-year yield goes is where the market goes. Today, both the market is relatively flat, but we were much lower this morning, but yields also backed off at about 4.4, 4.45% on the 10-year. We had an auction today at 1 o'clock. I haven't seen the results of that come out yet, but it'd be interesting to see what the bid to cover was for that as well.
Yeah, and Maddie, I think when we think about the inflation and the consumer is processing this very different than we're seeing what's happening with the market sitting at all-time highs. I mean, a number of surveys suggest that the consumer thinks that we are in a recession, that unemployment's as bad as it's been in, 20, I think it was either 20 or 50 years, I forget the exact number, but the data just points to something completely different. There's almost like that inflation hangover that they've been feeling the past 4 years.
This higher for longer environment that we've been in is really frustrating to the consumer, at least the average consumer, especially when we look at housing. Home purchases are really getting delayed and drawn out. More people are shut out from buying houses. Rent costs are continuing to rise. A lot of savings that were from the pandemic have really dried up. And so a lot of these household debts continue to increase. We saw Redfin, just 16% of listings last year were affordable for the typical household. So on top of that, a lot of kind of the accessory fees, including insurance premiums and property taxes, are also on the rise. So the average consumer is just getting really frustrated.
Yeah, and the point is, we keep talking about this, if we were to get maybe 1 or 2 rate cuts this year, is that really going to move the needle, right? Because the lower end consumer, they're grappling with higher debt, higher credit card balances, and interest rates are higher. The higher end consumer, if they have cash and savings, they have the higher interest rates on the savings account. So moving that by 20, 50 basis points, is that going to resolve the issue that higher insurance rates are 20 to 25% higher than they were 4 years ago? Is it really going to move the needle? And if you get too many rate cuts, what does that signal about the economy?
I think the consumer really wants to see a 0% inflation increase, which we will never see, but mentally that continued increase will continue to frustrate them, and they will still be paying more over time for goods.
And you're going to hear about that, Chris, more going into an election season, because while it might be 0% year over year as a round number, it's not what they were paying 4 years ago. And in an election year, you're going to hear about that.
All you have to do is listen to the consumer conference calls from the issuers, and you're going to see the difference between what the haves and the have-nots. When you look at the 3 buckets of consumers out there, you have the low end, the middle class, and the higher end. Right, the higher end companies that cater to those largest, which is travel, leisure, specialty retail, they're doing very well, and they're forecasting for stronger year. What you're seeing on the low end, the trade down, lower end consumers don't have the money, to Maddie's point, that they did when SNAP has run off, the COVID checks have run off. They don't have the money to spend. Even though you're seeing wage increase in the data is always backwards looking. When you want to see what's moving the market forward, you want to look forward to what the corporates are saying. They're giving you guidance to what's moving out into the year. The corporates that cater to the dollar stores, the lower end fast food chains, what they're looking at is a slowing of growth. The middle class is trading down, but there's not enough uptick for the lower income folks who are not spending. And you're seeing that in a number of corporations. They're warning about that on the earnings calls. They're taking down their guidance, and that's going to impact the market. So at the end of the day, while you still look at the jobs report from Friday and you see wages do increase, You're still seeing the unemployment rate tick up to 4%, and new claims came out Thursday, again, trailing 2 weeks, and you're looking at an uptick there as well. So you do have the softening economy, maybe the righting of the economy. The interest rate part of it is curious, but not really going to make an impact. It's a 2025, 2026 story, not this year. Back in November, December of last year, when you're pricing in the market 6 rate cuts this year, you know, that would have been a story this year. It's not.
Well, you know what, Q1 earnings were quite decent, and we see the market moving up on fundamentals versus, you know, just relying on rate cuts. And, you know, Maddie notes here, S&P 500 is up 30% over the last 2 years, and that's where your bifurcation is taking place. But I want to bring in Brian for a moment here. Let's get a technical read on it, Brian. I want to hear more about, you know, the consumer surprise index, what you're seeing there, and then of course they're going to be concerned about the price at the pump. So tell us what you're seeing in terms of the consumer and how oil is relating to that, as well as what it could signal for rates.
Well, regarding oil, we've seen that it's down about 17% from its highs from recently in April down to its lows last week. Just in a 5-day stretch, it was down more than 10%. So that's been rebounding since the middle of last week. So we've recouped around 5% of those declines, maybe a little bit more. But we could see on that downtrend of the last 2 months that any rallies are really getting stalled at this 200-day moving average. And so we still remain below that level. And if you look at a longer term chart, you know, we could see that over this the last 2 or 3 years, there's been reliable support down at $70 or so. That was the lows in December and in the first quarter of 24. Again, back in the middle to early stages of 2023, did manage to get down as low as 66, but most weeks closed around the $70 level. So came within 3% of that last week. We're seeing a little bit of strength this week, but I wouldn't be surprised if maybe we see you know, a continued move to the downside over the upcoming weeks. That would potentially be, or would be, you know, a benefit to the consumer. The economic data, the Citigroup Economic Surprise Index, has been slowing quite a bit. So this is economic data relative to expectations from the community of analysts, and we can see that it went to a sharp decline here from mid-April into the end of May, and it's been recovering a little bit so far in June. But you know that did lead to a pull down in longer-term rates that we saw over the last couple of months or so.
All right, Brian, we'll be back to you in just a moment here. But Maddie, let's go back to the point that you had made in your notes. S&P is up 30% over the last 2 years. It's a top-heavy rally, and not all market caps are participating.
Yeah, major index performance is really driven by a few large companies. The market is top-heavy. The combined market cap of the top 3 companies in the S&P 500 is roughly equal to the combined market cap of the bottom 350 companies. So that just goes to show you the kind of gain that the top companies in the S&P 500 have. Last week we saw the index gain 1.3%, but when we look at the equal weight index, it actually declined 0.77%. And when we look at the 2-year range, up 30%. When we look at the equal weight index, it was only up about 11%. So really this is a top-heavy rally with mega caps driving the bulk of the gains.
Yeah, I mean, Russell and microcaps.
Yeah,
just not participating.
When we look at those stats last week, 74% of the Russell 2000 was down, 70% of the microcap was down. So they're just not involved in the rally that we're seeing.
Yeah.
You know, it's all AI. That's the tailwind of the whole thing, and their market cap performance within the indexes that they're in. If you look at the Dow, which is not really a good indicator of the market, but really the Main Street index that most people quote when they look at it who are not involved in trading every day. For today's example, you only have 8 companies that are in positive when we came in out of the 22, but again, that's price weighted, not market cap weighted. And most of that weighting comes with Apple making a new high today on the back of their WWD day yesterday, especially with the new announcement. AI now stands for Apple Intelligence. So that's an interesting thought, because now Apple was always late to the game. As one of the largest companies in the world, what is that going to impact the other markets? Again, it's going to show the bifurcation more so, not just the Magnificent 7, it might not just be the Magnificent 3.
Well, Chris, I'm going to push back for a moment here, because we did see rotation into other sectors when you think about AI and who's going to power all of this. You saw what utilities did in May.
That's
you
the
saw
tailwind of it. Yep.
So are you starting to see breadth widen out a bit here?
Utilities was a surprise trade, but if you did your homework, you would have known that you're going to need the power to create these chips.
Right.
And that's where that is coming from. You're seeing banking getting hit today on a number of different conferences. Some of the majors are getting beat up as well. Again, going back to consumer and commercial loans, there's going to be issues there moving forward, especially if you look at the data for commercial credit, consumer credit, auto loans. They're starting to see default levels a little bit higher than the pre-pandemic numbers, which is a little bit scary, especially if the dollar value, even though on a percentage basis is not as high, the dollar value of credit right now is significant off the when I looked at the New York Fed note last week. So the question then comes down to, when you look at the S&P, you look at the mid-cap 400, you look at the S&P small cap, and then you, to Maddie's point, you bring in the Russell, which encompasses most of the 400 and the 600. The participation isn't there as much. Earnings are better across the board. We saw a nice Q2 earnings period across the board, definitely better than expectations, and the expectations are that will continue forward. But the consumer really, as almost 70% of GDP, and we had the GDP dialed down the previous week as well to 1.3% for the second quarter. I'm not sure where it's going to come from.
Well, before we bring Brian in here to take a look at breadth for a moment, and I haven't had a chance to go through this, we've been up here, but the Biden administration is proposing a rule to ban medical debt from credit reporting, aiming to improve the credit scores of millions of Americans. And that doesn't mean that that credit or that debt is removed from your credit profile and it's still owed. So my question is, and again, I haven't read into this, so this is just top line thoughts. Doesn't the risk profile get shifted to the bank if they're not able to see how much money is owed, what their debt to income ratio really looks like?
It does.
Right? What does that mean? You know, looking further out, again, I haven't read through this whole thing, but what would that mean if you can't appropriately judge someone's creditworthiness? Something for us to take a look into, a report back on that. But Brian, let's bring you back in here. Let's take a look at some debt indicator, breadth indicators. You might be on mute.
Sorry.
There you go.
We know that the Russell 2000 has been, underperforming all year. That hawkish repricing of rates, where we went from 170 bips of rate cuts this year to 30 to 40 bips now is what the market's looking for. Certainly a bigger headwind for small caps. And so they peaked in December, made their 52-week high back then. So what I'm looking to now for breadth, because I think breadth has been better than a lot of people have been saying up until the end of the first quarter into the early stage of the second quarter. So when we look at the S&P 500 equal weight index, this index was making new all-time highs back in late March, early April. And the same thing for the S&P mid-cap index. But more recently in May, when we saw the Nasdaq 100 and the S&P 500 resume their uptrend and make new all-time highs, we didn't see the same thing in those the equal weight index and in the mid cap index. And so that to me was one sign that breadth was getting weaker than what we had just seen in the first quarter of this year. And then here's a look at the S&P 500. This is the cap weighted index, but when we look at we're looking here at the top quadrant is the S&P 500 index, the price index. It's a line chart. You can see it's making new all-time highs in the last month. And below it, we're looking at the percentage of stocks across 3 time periods, 52-week highs, 24-week highs, and 12-week highs. And for 2024, all 3 of those metrics peaked back in March. Some of them actually made higher highs back in December when we had that initial blow-off move over the last 2 months of the year. But even for 24, we've seen better highs in March than we are seeing in that index in the last month or so when the index itself is making new all-time highs. So we're definitely, even within the larger cap space, seeing some breadth divergences taking place, as well as in the mid cap space. So small caps have been lagging all year round. That hasn't been a good indicator. It's been a strong year for the overall indices, but we're now seeing breadth within those stronger groups. Really what's been driving the price action in the second quarter has been large cap growth. And that's the names that you guys have been talking about, the Mag 7. In the second quarter, the Dow Jones is down, the Nasdaq and S&P 500 equal weights are down, mid caps and small caps are down, 7 out of 11 large cap sectors in the red, 9 out of 11 small cap sectors are in the red as well. And so, one group to pay particular attention to, I think, is the regional banks. They've been underperforming, but now they're testing 4-month support. They're down back below their 200-day moving average, and we're approaching. Tomorrow is an FOMC that we've been talking about. So if the Fed is going to be hawkish or more hawkish than what maybe the market is anticipating, I think this group is at risk of breaking this support range. Conversely, if we have a more dovish Fed, then I think, you could argue that, this being in the bottom of a 2-month trading range, you could see maybe some significant alpha in the very short term from this space if the Fed is not as hawkish as maybe the market's already pricing it.
All right, Brian, appreciate the technical insight as always. So, Maddie, to wrap up here, it's really back to the Fed and inflation data for this week. Yeah.
Tomorrow, we're going to see 2 main catalysts. First, CPI data come out, then the FOMC meeting. Policymakers are expected to keep borrowing rates steady, but what everyone is focused on is the dot plot, so the projection of any Fed rate cuts to come.
Right.
All right. Appreciate insight as always. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.